Guys, welcome to this video. My name is John Watts. I'm a consumer protection lawyer. We're going to look at an IRS tax decision. And what I want you to learn from this is that there is a type of offer in compromise that is sometimes called effective tax administration. And that can be very, very difficult, even if you have a very serious problem such as a gambling addiction. So let me just take a step back. Basically, three types of offers in compromise when we owe the IRS, whether it's a little bit of money or particularly a bunch of money. Number one is when we say, hey, we don't think we really owe this money. And the IRS agrees, and so we compromise. We settle on an amount because maybe we're right, maybe they're right. That's pretty rare. The second one's the most common one, which is there's no question about liability. We owe the money. The question is, do we have the ability to pay it? And so that is doubt to collectability. That's by far the most common offer in compromise. But then there's a third one that's very, very rare, and that's where we owe the money and we have the ability to pay, but we can make an argument to the IRS that it would be unfair to make us pay that. And we're going to see somebody here made that argument. And they have a very difficult circumstance, but ultimately it was rejected. So let's take a look at this. This is from the 7th Circuit back in January 2020. And so we have a tax court decision upholding a levy. A levy is where they seize bank accounts, accounts receivable, wages. In other words, they're taking your money or your property to collect unpaid income taxes from 2012. And the court says, hey, the tax court correctly upheld your liability and accepted that the IRS, or acceptably conclude the IRS acted within its discretion when it rejected your offer in compromise. So this all comes from the taxpayer's compulsive gambling. And this was related to some prescription medication. And so look, there's this little side note, but most prescriptions have some type of side effect. And sometimes it can be something that would be very unusual. Like, why would, having restless leg syndrome and some medicine for that make me become a compulsive gambler? It happens, okay? So she starts increasing her dosage and says by 2012, her gambling was out of control. Stayed at casinos for days. Neglected her hygiene. She took $104,000 from her IRA. And she did own 29 properties, but she stopped paying the mortgages, property taxes, so some of those started going into foreclosure or tax sales. And eventually she got off this medicine. And so we have here the tax liability was $85,000, and then we have this to $75,000 they did not pay. And so in 2014, they get a notice of intent to levy certain property. And this is really good because probably 90% of people do not do this. It's kind of the same percentage of people that are sued by a debt collector and they just don't answer. That's what most people do at the IRS. You have a very limited time period to request a collection due process, CDP hearing. And these people did it, so that's great. And they said, look, we'll submit an offer in compromise and we'll pay you, just call it $39,000. And you're supposed to say why. Well, exceptional circumstances, which is often called effective tax administration. So they acknowledged they owed the full amount of taxes and had sufficient assets to pay, but asserted due to exceptional circumstances that would cause an economic hardship or would be unfair or unequitable. And this would be the gambling and then the consequences that flowed from that. So the offer examiner looked at that and said, well, wait a minute, your net equity is $813,000. You got more than enough to pay the full amount due. And so here's 2 rental properties. You should sell those. And the taxpayer said, no, I need the income from those for retirement. And the settlement officer said, hey, you've got sufficient equity in real estate to pay the full liability, and we're not going to compromise. And so then the taxpayer sought review of the settlement officer's decision in tax court. And this is pretty common, okay, what we're about to see. The tax court, though, sent it back to the Office of Appeals because the settlement officer had addressed economic hardship, but had not addressed whether this public policy ground or effective tax administration was sufficient. So then the settlement officer held a supplemental collection due process hearing, CDP hearing, and the settlement officer again rejected the offer in compromise and sustained the levy. And the officer considered public policy and equity grounds and said, you don't meet the requirements. So then they go back up to the tax court and said, we want you to review what that settlement officer did. And there's a discussion about the various evidence and witnesses. And the petitioners say, hey, settlement officer rejected our offer and compromise based on prejudice rather than facts. And we'll see that in a moment. And so the tax court reviewed the officer's rejection of the offer and compromise and concluded the petitioners not argue for a compromise based on economic hardship and did not qualify regardless. As to public policy or equity grounds, they said it's unfortunate what happened to you with this gambling addiction, but the settlement officer did not abuse the discretion in rejecting the settlement. And so we're not going to really talk much about this 10% penalty other than I think we have one little section in here. I just want you to see this because this is useful to keep in mind whatever type of case we're dealing with. Petitioners insist tax code's definition of disability is outdated and doesn't fit with sort of the current thinking, and the taxpayer saying, hey, look, my gambling addiction was a disability. And the court says this argument is for Congress, not the courts. The judiciary, judges, they're not authorized to redraw the boundaries set by Congress. So go make that argument to Congress. And then we have this alternative minimum tax assessment. And ultimately, the argument is just an appeal to fairness. But this type of tax has no equitable exceptions and is not feasible judicial undertaking to achieve global equity in taxation. It just means if you don't have a clear path to a settlement or a compromised amount, it's highly unlikely you're ever going to get any relief. So then the petitioners say, well, look, you should not have rejected our offer in compromise because we had two arguments, economic hardship and public policy interest, and that should have compelled you, settlement officer, to accept our proposal. And the court says, well, we're going to be very deferential and, we're not going to substitute our judgment for the settlement officer, but we'll certainly look at what was done and just make sure it wasn't crazy. So let's look at this economic hardship. So we have to show collection of full tax liability would prevent the taxpayer from paying reasonable basic living expenses. And the taxpayers say, hey, if we had to sell two of our properties, this would be an economic hardship. And the court says, but the record does not support that. It says, actually, you didn't want to sell those two properties because you want to use them in retirement. That's a different question than can you pay your current living expenses, your basic living expenses. And I didn't highlight this, but the taxpayers say, well, there was an error. Something was marked as $8,904, said $3,904. And the court says it doesn't matter, okay? Because it wasn't your income and expenses that sort of sunk this ship. It was the fact that you got $800,000 in equity in real estate. So there is no economic hardship. Now, what about this public policy equitable justifications? So the test is collection of full liability would undermine public confidence tax laws are being administered in a fair and equitable manner. So let me give you an example. This is kind of the classic example. Let's say you've got a guy, 90 years old. He's on oxygen and very limited mobility. He owns a house that's worth $300,000 and he owes $200,000 in taxes. And the house is perfectly set up for him to be able to live in, but it would be very, very difficult to find another place like that. And he's got, like 9 months left to live. Well, the IRS might say, you know what? We're not going to sell your house. Even though your house has sufficient equity, we're not going to sell it because we have these extraordinary circumstances. And that might undermine public confidence. I mean, it looks kind of bad, right? To sell a house from a 90-year-old guy who's about to die and like let the man live there in peace. Okay. So that's the idea. It's very, very, very rare that this happens. And they say we cannot say it's unreasonable to determine the situation was not so extraordinary to require compromise because look, you're able to file your tax returns accurately and you're able to collect rent. So you may have had this disability, but you were still able to run your business. Now, evidently, it was being run in a little bit of a challenging way because some stuff was going into foreclosure. But nevertheless, the court says that was not an abuse of discretion. And then they say there's no basis that if we reject this offer that it would undermine taxpayer compliance with the laws. And so I didn't highlight this, but the settlement officer said that the taxpayers did not act reasonably or responsibly, and the court says, well, perhaps worded sharply, conclusion finds support as a factual matter. And then there's some arguing over witnesses that were excluded. And then I want to just show you this last part. So the bottom line is taxpayers lose, but this last part teaches us a principle when we're looking at appellate courts, and that is they typically only decide what they have to decide. And if there's no reason to reach some other issue, then they don't do it. They say, we'll save that for another date. So the IRS commissioner asked us to weigh in on whether the tax court's review of non-liability issues, for example, rejecting an offer and compromise, should have been limited to the administrative record from the CDP. Remember, that's collection due process hearings. If you remember in this case, I said there was some arguing about, well, we want to bring these witnesses and put this evidence in. And the court says this case does not require us to decide that question. Okay. And they say our analysis shows the commissioner prevails on appeal, even if the court did consider evidence outside the administrative record. And so we don't have to reach it, and the taxpayers lose. Okay. And again, I'll put this link. But again, the point of this case is if you are trying to do an offer and compromise and liability has been admitted, and for most people they do admit it because they miss their chance to challenge it. So that's offer and compromise number one. Offer and compromise number two is doubts to collectability. Well, if you have the income to pay it before the statute of limitation expires, and we have video, I don't know if it will have already been released or will be released, about the statute of limitations for the IRS. Basically, it's 10 years, but there's a lot of things that can pause that. So if you have the income to pay it over the life of the statute of limitation before that expires, then there's no doubt as to collectability. Or if you have the assets to pay it. Like here, these people had $800,000 in equity in real estate, and the IRS is like, just sell a couple of your properties and pay us off. Then you're not going to meet that second requirement. So then you get to that third requirement, the effective tax administration, and you have to have some really, really extraordinary reasons. It can't just be, hey, this is going to limit our ability to go on fancy vacations, okay? Or I want to be really comfortable in retirement. I mean, it's got to be extraordinary. And look, these folks, I mean, that was their only argument, okay? So I don't fault them for making that argument because, you know, the settlement officer could have agreed with it. And then that would have been great for the taxpayers. But it's a very hard argument to make. So just understand if you're going down that path, particularly if you're doing this on your own without competent either a lawyer, a CPA, or an enrolled agent, and obviously you got to have a lawyer if you're, you know, in the appellate courts here. But if you're doing this on your own, just understand it's a very, very, very steep mountain to climb to do that effective tax administration. Okay, guys, I appreciate you watching this, and I'll catch you in the next video. Have a great one.